Welcome guys to another weekly update. Today we're gonna focus on the previous week, so from 18 August to 24 August, going straight into it. So the current agenda, or my agenda today, is I want to dive a little bit deeper into the recent macroeconomic data which got published. Then I want to go into my current macro picture to frame it a little bit for my current portfolio structure. And then I also want to show you one Austrian stock because I'm very focused on the Austrian stock market because I think it's a really nice market to trade, especially as they are really nicely following the overall business cycles. And I want to look into with you guys into a stock which pumped quite good the last few months and very cyclical stock and DO&CO. So their focus, we'll go deeper into that. They're focusing on airline catering mostly. So around 80% airline catering business, 20%, yeah, 15% event catering, and they also have restaurants and hotels. But we'll go deeper into that. Starting with the recent macro data. Starting with the housing market. Overall, a very bearish prints we got here, starting with US building permits. So overall, the overall scheme here with 1,354 on July, which is around -3% month over month. What is quite bearish here is, of course, the trend we're in. Like starting in, I don't know, 22, no, not 22, but like mid 23, we actually are seeing this downtrend continuing and not stopping. On the single family permits, we actually saw a stronger recovery here. We actually also got a pretty much more deeper correction here, but we actually got the recovery. But now this negative downward momentum seems to continue, or it seems to gain on momentum, which is really the thing which is quite bearish. Same picture in the NRP housing market. We also saw somewhat of a recovery, or some not achieved recovery starting in late 23, and we are currently still continuing this downward momentum. Vice versa, it's actually interesting that the manufacturing industry is quite bullish with a very bullish print on 53.3, and I really would recommend you to go through the S&P Global report. It can be read in 1 or 2 minutes, but I can just summarize you pretty quickly what stands here. So we saw the largest influx of new orders since February 2024. Factory employment rebounded after a decline in July to register the largest April gain since March 2022. So we are seeing actually reverse happening in July, where we actually saw very bearish data, especially employment. So if you have the numbers in mind, probably not, but just saying about that topic, that the ISM manufacturing is actually delivering a whole nother picture. Yeah? So it's really important. Like this index print is actually very bullish and should signal for the recovery in the industrial product, in the manufacturing space, or generally in the industrial production. But the ISM manufacturing is giving a whole different vibe here. So we really need to look at the August ISM manufacturing, in my opinion. It's still quite bullish. Initial claims actually come in a bit higher than expected. Expected was around 2025. So a bit higher than expected. Overall, the trends, what we can see here, which is generally in the employment market, is quite weakening. Still not at recessionary levels, still not as bearish as the non-farm payrolls, but overall a clear negative momentum. Also quite interesting last week was the Jackson Hole. So Fed Chairman Jerome Powell talked, and he was quite hawkish. So quite hawkish stance, and the markets are also pricing in high probability of a rate cut in the next meeting in September 15 or September 16, I think, something around that date. So in around 3 weeks. And what we're seeing here is what I wanted to show here is in the past where we actually got interest rate cuts, that this was always a more or less bearish signal. So going back to the last recessions, so the gray we have the recessions, it was always the start of a recession. In 2000, actually, the only point where we didn't have this kind of situation was in 1998, where we also had a rate cut, but didn't get a recession. Also actually in 1985, but it's still a quite shocking signal, especially if we look at if we get later to that, if we look at the current bond market pricing of the 2-year yield. I think this is more or less the signal, and also, of course, if we look at the Fed futures market, there are a lot of priced in rate cuts in the future. But what I want to show here is that rate cuts are never a good signal, especially if you drop them that hard. And if we also combine that with the current housing market index, it just is another confluence that we might having a more negative momentum being built up. Yeah, the second chart, same picture, we're actually seeing an increase in the unemployment rate, so down is bad. Increase, I've inversed it here, but here down is bad. So an decrease in interest rates always followed an increase in the unemployment rate, which of course is not good. Also similar picture to the CPI, so it actually is reversed. So lower interest rates are actually also a signal of deflationary monetary conditions. But now the second one of the agenda, deep dive into the manufacturing industry. And here I want to start on the left side of the slide. So as we can see, manufacturing production is actually recovering. Vice versa, employment is very bearish. But in the past, we actually saw the left side the message that the manufacturing is actually leading. So the manufacturing part is leading, which is kind of makes sense, I would say. And if we look at the right, I tried to look at some leading indicators which might predict the future of the manufacturing production. And starting on the top, we have the GCM leading manufacturing composite, consisting of those 5 leading variables, so more or less more or less new orders of the manufacturing industry, which should lead to the overall production index, of course. And as we can see here is that we can see a clear stagnation. But in my opinion, the more important indicator in orange, where we also got that very bullish print, is the S&P Global Manufacturing Index. And this is actually a very good leading indicator for the manufacturing coincident, which is the big picture of the manufacturing situation, which just combines industrial production and manufacturing employment. As we can see, it's very, very leading. And here we can see strong recovery. So we should also expect recovery in the manufacturing industry. In reverse, we actually see a whole different picture of the economy, of the residential, the housing market. I want to keep it very short, so same charts. So production indicator, in that case, it is housing under construction. On the right, construction employment, and on the bottom, the growth rate. As we can see, actually the production variable of the residential housing market is actually is at levels comparable to past recessions. And looking at the leading indicators, this picture will not change in the next 3 to 6 months. In reverse, it will probably worsen, which gives an highly likelihood of a recession. But yeah, I just want to make the point one more time. What is, in my opinion, so bearish is that we had the recovery in 2023. Looking at the TCM single-family housing market, combining those three indicators we saw at the beginning slide. So as we can see, downtrend is continuing, and we are at levels where we saw a recession in the past. Actually, also the decline from peak is just giving more bearishness to that, which is actually at levels, past the 1919 recession, and also from months, counting the months from peak. So we saw a very deep decline and also a very long decline. So a lot of duration and also momentum to the downside, which is of course not a good mixture. Here I want to highlight the possibility that the housing market is right here. So in the past, we more or less saw that both are kind of moving in the same direction, but here we're actually seeing the reverse. So manufacturing is recovery, housing is having a more downward pressure. In the past, we actually saw them moving quite the same, but we saw some periods like 1975, actually also 1966, actually saw that the housing market is actually leading. But in my opinion, what is more interesting is that picture. So as we can see, I have here in the blue the US 2-year yield, in orange, yellow the US building permits, and then in black the US interest rates. And as we can see, the 2-year yield is in a very clear downtrend. So that's just the expectations of the market of future growth, of future interest rates. And looking at the trend, it just signals that the bond market is positioned very bearishly and is expecting further rate cuts. And further rate cuts, as we already mentioned it, was a very bearish signal in the last 3 recessions. Combining that with the building permits being at levels where we had a recession in 2007, right after 2 months or 3 months or 4 months. So not seeing a recovery here is quite devastating. Yeah. Now looking at the third part of my agenda, the current, I think I didn't even have an agenda for that, but it's not that important, is where are the markets currently trading. I want to keep it very fast here, so just summarize what I'm seeing here. Tech underperforming, Russell 2000 outperforming, and silver, so hard currencies, performing very good, and dollar and euro newt decrease in value, but not that extreme, right? Only minus 0.1%. Yeah, I think that's a topic which you might have encountered quite a lot in the last few weeks or months, is the very high valuations. But as you might know, the market can stay irrational long as we can stay solemn, but it's just another confluence, and that's what we're always looking for. Confluences. I think that's also really interesting On the left is the previous up cycles of the last 4 years, where we mostly had around 32% to around 38%. So we are at that level where we just also, even though we might not have a recession, we should expect maybe a little drop, like maybe 10%, maybe 6%. That's not unlikely. Also quite interesting is the high weighting of the high concentration risk, which we also had similar to past recessions, so 2020 and 28, which is also really interesting. Same picture, I would say. The market, maybe starting VIX, is pricing very low volatility, is pricing very low risk, looking at the credit spreads, and also the emerging markets is at past business cycle highs. Also kind of interesting. I think that's a good conclusion here of my current macro picture. Of course, the trend is still intact. The overall trend is still intact, but we also see another confluence here, which is, in my opinion, quite interesting. So on the pink line, we can see building permits. In the past, this level at around 1.4 million was always a recession signal. We can see the Russell to S&P 5 spread being at levels which also was a recession signal in the last few years. So that the bottom here was always a recession signal, and we are actually at levels only comparable with 28, which is also another confluence. And if we look a bit more deeper, the Nasdaq is experiencing a lot of weakness, well, not a lot of weakness, but actually the tech-focused ETF, so US tech, only tech, is actually down, as we can see in the next slide. It's actually down minus 0.1% month to date. So August was very bad for tech, was really very good for home builders, but they were very oversold. But it's actually a thing I'm coming now. So to conclude here, from my current macro picture, I think we have a lot of confluences that we are at levels where we should expect maybe a little pull down. And what is my current ideas out of those situations is, just because the home builders are being up 16%, I'm looking for a short here. I'm not going to like market short right away. I'm just looking at the market structure and finding a good timing, because this is always a thing. The timing is of course the most important thing. And from my portfolio construction, I want to long more defensive stocks, so Verbund, Post, FAC. So if you don't know Austrian stocks, you maybe don't have a picture. You might don't know the stocks, so it's not important. But I want to long defense and short cyclical stocks, which performed quite good the past few weeks. Now, as I said, I wanted to look into a company which I also looking forward to do every week, and now it's DO&CO, actually the best performing stock in the ATX, I think, together with Erste Bank probably. So DO&CO, as already said, I think in the beginning, they're mostly doing catering. They're mostly doing airline catering, which is like 80% of the revenue. But they're also doing event catering and restaurants and lounges and hotels. As you can see, very strong recovery out of the Corona years, fiscal year 20, and seeing a very strong revenue growth. Now, actually, it didn't updated the fiscal year 24. We actually have real numbers here with a revenue growth of around 25 years, but we'll look into the model. So that's what they're doing. Yeah, as we always said, 76% airline catering, and what they are really good at is they really focus on that high-end airline catering. Yeah? And they're actually the best in that. They also have the pretty long partnership with Turkish Airlines, and they're also the biggest kitchen, like it's crazy. And they're also doing event catering. They also had a very long partnership with Formula One, which is also very good. So they also should have, I think, very sticky cash flow. So the customers should be very sticky. But also doing FC Bayern München catering and also Champions League and also quite prestigious events like tennis events and so on, but also concerts, which is also interesting. And they also have restaurants, but it's like 8%. Demo might be anything some of you know. And now I'm going to go into the current valuation, which I'm looking forward to. So as we can see, it's a very cyclical business. It's also focusing on more the rich people, I would say, and currently is trading at around 227. We actually took the old high out, so maybe looking for a swing failure pattern here. And coming up, if we see a revenue decrease, which in my opinion, from the current macro situation, is not very unlikely. Like I could absolutely see that. Then, in my opinion, an share price around 190 would be more reasonable, especially with the current macro outlook going forward. And we also have somewhat of high valuations. Looking at the PE, still a fairly reasonable EBITDA multiple, but still overall a very good business. I really want that in my portfolio, and I'm to have that also possible for very long-term play, because I think that's a really cool and niche business, and they're really growing good, but they're growing 18% CAGR of the last 5 years, so that's very good. But going forward, I'm expecting an possible revenue decrease. If you go with 10%, they're sitting at 200, so maybe it's a fair price where you're currently sitting. Like 200 is probably a fair price. Still, probably looking for an possible technical entry here. Yeah? So that was it from my side.